Good afternoon, everyone. We have just about 15 minutes left into the close here, and I think it's a good opportunity to visit what happened with today's volatility with the FOMC meeting minutes being released. Now, this is going to be another continuation in our series of studying what happens after FOMC related volatility. Be it meeting minutes, be it a Powell testimony, be it something completely different, what tends to happen after one of those events, an FOMC catalyst as our catalyst for volatility. Now, if you'd like to see some previous examples, I'll leave this link in the description box. It contains examples from June, March of this year, January of this year, and goes all the way back to 2019 as well. That should give you an understanding of how FOMC volatility has really changed over the years into now the model that I think we've become accustomed to seeing. Now with that, let me first explain the pattern that I think we see more often than not for FOMC related events. We have first the initial reaction. We then typically see a fade of that reaction, which breaks below this previous low. And then we have a recovery, usually towards this halfway point, taking us to really that mid zone right here, right around here. Now at this point is usually where the decision making needs to happen. Do we see A, the bulls being in control, in which case price continues to rally, sometimes chopping around here, sometimes breaking even above the previous high? Or do we instead see bears taking over, where price fails at this point and instead either chops around or breaks below our lows? Now, for the most part, the predictable part of this model is the yellow line. That's the part that I think we see happen more often than not. The green and the pinks are where you have to use price clues to make that decision. Now, if we take a look to see what ended up happening today here, let me zoom in. In today's case, after the meeting minutes were released, we had our initial reaction. So this was part one, that first yellow line. We then had a fade of that reaction, breaking below this low, but not all that much below this low. This also happened to overlap with our volatility box zones real time. If I show you a screenshot, a very poor quality screenshot, but this should still help illustrate that idea. We had first price move, and then we had price come back down, tag our sign lines, and then bounce up from there. This now takes us to that decision point that I was just alluding to. Coming back into what ended up actually happening, the place where that decision point came in, this big green candle, was then met with continuation from the bull. So in today's case, we had the bullish side of this being met. The green line where bulls ended up breaking above the previous high as well, and really having full control with a new trend to the upside. Now the question comes in all of this volatility, where, if at all, did we get any opportunities to participate? Now I already showed you the screenshot first using our scalper models. This is where price hit our sign line to the bottom side, and we already hit T1 before getting an opportunity to enter even on a 1-minute chart. So unless you were very aggressive or you were just not waiting for something like an overbought signal, that was your opportunity to play this overall bounce. After that, let me show you the scalper. Once we ended up bouncing from this level, we then had so much bullish strength that we went straight outside of our volatility box clouds on the upside. Now the first time we see that oversold signal is right here, and that's after price has broken outside of the clouds. That means we need to adapt to our new volatility models, a little bit more conservative, take advantage of the fact that volatility is increasing instead of being relegated to only 1 or 2 models. Instead, we get to switch over to the aggressive and now participate in this fade reaction looking at our new levels here. Now in this case, we had price breach the upper edge of the volatility box. We then had the oversold signal. In terms of the move we were looking at, that was right around 16.5 points we were looking for. We ended up going a move of right around 13.75 points before price reversed, and we're now starting to see that sell-off, which hopefully should give us the continuation, breaking even below that 38.50 lows into the final close. Either way, it should give you an idea of where price action ended up halting. So for the model, we went like this, and then ended up going all the way up to our levels before halting at this point, where now price has really just been chopping around sideways, and we're starting to see the selling come into place really after that 12:30 mark. So again, just to recap, we did see again that same pattern being met. The initial reaction, a fade of that reaction, and then finally a move up. In this case, we had the bulls in control, with price then stopping towards the upper edge of our volatility models. We can now see that flush move down lower, taking us below that 38.50 mark as well, really looking for this same initial trade to now start to pan out in terms of giving us T1s. Hopefully this video helps. Again, for those of you that are curious to learn more around FOMC volatility and trading it, I'll leave a link to our page with all of the FOMC videos in the description box, and you can go through those videos to find some other examples. Hope this video was helpful. Take care, everyone. Have a great rest of your week, and we'll see you in the next update.